Welcome to Markets Today. I'm your host, Mbithe Mwema. It's a new month and it's certainly one that we hope will be a happy month and full of pleasant surprises, at least for us here at the team at Metropole, as well as for the global economy and the Kenyan economy. COVID is tapering off, but we do see a lag effect in terms of a possible financial crisis that could hit the global world as well as the Kenyan economy. That notwithstanding, we have seen the Kenyan banks come in droves in terms of announcing their first quarter 2020 earnings results. We will be taking a deep dive in today's show and going through these financial numbers. For your benefit, we have seen Equity Bank, Absa, Standered Chartered, I&M and Housing Finance all announce their first quarter results in the last week. Equity's numbers were down 13% to 5.3 billion. The downward trend has cut across most of the banks. We saw Standered Chartered come down minus 16.6% to 2 billion. I&M Bank was down 31% to 1.6 billion. Absa has been the star in this week in terms of its announcements. Its profit after tax was up 3% to 2 billion. What's happening in these numbers? Why are they reporting lower growth rates compared to last year? But more importantly, is this a trend that we need to look out for the rest of the year? That's the subsequent 3 quarters before we get to the full year. For you as an investor, does this have any impact on the dividend that you get out of this company? Does it have any impact on the absolute profit after tax numbers, which are the numbers that really dictate the dividend payout for you? Let's try and understand these numbers, and we start off our conversation today looking at Standered Chartered numbers as well as I&M numbers. We are joined by Linda Kiratha. She is the head of research at Apex. Welcome to the show, Linda.
Thank you, Mwema.
So what has been your read-through for the numbers that are coming through the banks in brief?
It is important to note that the year started on a very positive note. Following the repeal of the rate cap, we have seen a rise in interest income for a few of the banks. However, given the current pandemic, we have also seen a very huge surge in loan loss provisions. And I would say this is what has mostly been eating into the bottom line. We have also seen a rise in operating expenses from staff costs. And basically, this is what has brought the earnings down from what was experienced last year. It is quite unfortunate that we were hopeful following the repeal of the rate cap that business would thrive so much this year. Unfortunately, with the pandemic, that has not been the case.
Thank you for that overview, Linda. When you talk about the loan loss provisions, what is this looking like in as far as non-performing loans are concerned? And more importantly, is there any link to what's happening with the economy, and could this be a continued trend as we get into the latter part of the year?
We have seen banks do restructures where they're giving clients holidays for interest payment and even for principal payments. And it is expected that this, unfortunately, will be the trend going into quarter 2 and quarter 3. When you talk to banks, they say that at first CBK had given them an allowance of 3 months to offer the clients the holidays, but unfortunately that is not enough. Business has really been down. Up to now, we see that our economy is still somehow closed. Business is not back to usual. So going into the year, that is for the full year 2020, we definitely expect to see an even higher rise in provisioning.
Much for that. Let's take a look at the Standered Chartered numbers. These numbers are down 16.6% to 2 billion. And management also came up and postponed the dividend that they were supposed to pay out, which was 15 shillings per share. Please walk us through the top line and the decisions that are coming from management at this bank.
The top line declined, as you've said, by 16.6%. And this was due to a 5.6% decline in total operating income. And as we said before, a surge in a 5.7% rise in total operating expenses. When you look at the top line, that is the total operating income, looking at the interest income, it was down 4.3%. Standard Chartered saw a decline in a 7.4% decline in government securities, that is interest from government securities, and a 5.9% decline in loans, which is quite unfortunate given that in the first quarter, the rate cap had already been repealed and business was starting to pick up. However, we also saw the yield on interest earnings assets come down by 9.4%. If you look at the bank's interest expenses, they were down 1.3% to around 1.3 billion. This is because of a 7.7% decline in interest expenses from deposits. So you can see that the top line has already been eaten by lower interest income.
Was the bank lending less? What was the structure of its balance sheet in terms of loans and deposits growth?
Okay, we saw a 6.8% growth in the loan book. So, and also a 4.6% growth in the deposits. So the cost of funds seems to be still under control. They are managing their cost of funds well. However, if you look at the loan book growth, that is of 6.8% and government securities of 13.6%, it is most likely because of the lower interest on yield earning assets. So remember, even after the repeal of the rate caps, banks were clear to say that they will not be so optimistic on raising the interest rates. They would take a slow and cautious approach as they observe how the market is, what their competitors are doing, and definitely what also the customers are saying and what is their feel about everything.
So you have a bank it's growing in terms of loans, it's able to mobilize deposits, but when it comes to its revenue structure, there's a bit of a decline, especially from its government exposure. Was there any material impact from non-funded income, the income that it earns from using its mobile banking platform or its integration with M-Pesa?
Yes, non-funded income declined by 6.5%, which was also quite unfortunate, given that we've seen banks focus on using alternative channels to grow their top line. That is through mobile banking loans, through transaction fees on mobile. And this was also, the decline was caused by a 12.5% decline in forex trading and also a 12.5% decline in fees and commissions. And also given that their loan book has been lower, so which means probably lower lending online, definitely that's why we see the decline in fees and commissions.
That's very interesting. And then now when we come to the operational expenditure, you did say there was a surge in staff cost. What's happening there?
I would say I feel that probably the bank did some new hirings or some layoffs. We have seen banks try to minimize costs by merging operations, given that now they're more focusing on online transactions. So some roles are becoming duplicate, leading to some layoffs. So I would think that compared to last year, the bank maybe had effected some layoffs and also probably did some new hirings, probably in the areas of technology. We have seen banks take up expertise in the areas of technology in order to revamp their technological developments.
And what about the loan loss provisions? What was that as an absolute number? And what was the gross non-performing loans in terms of an absolute number for that period?
So the non-performing loans dropped to 5.6% to 20 billion, which is quite opposite what has been the market trend. And also the growth in loan loss provisions was also quite high. So we have seen banks take a cautious approach given the COVID-19 pandemic. So they've been shielding their capital base. That is why we also see the bank halt on the dividend payment. So the money is expected to cushion them from any unforeseen events. We are not yet sure how this pandemic will play out. There's a potential for a second surge in infections that would see probably the economy go on lockdown again. So banks are looking at preserving the cash to take up any opportunities that may arise in case everything changes. Nobody knows how this pandemic will turn out. And also to preserve that cash in order to protect their customers and also to protect their business.
Okay, thank you so much for that. But then now the key question when you're looking at Standard Chartered, what happens to the dividend? And what should shareholders make of this decision taken by management?
I think it's quite unfortunate for shareholders, given that Standard has been one of the greatest dividend players in the market. So for now, clients will have to accept the decision and understand that in times of a crisis, it is more important to protect their income going forward. If the bank feels like that by paying out the dividend, there may be unforeseen circumstances and they may need that cash, then I feel for investors it is good to just take advantage of the current lower prices, just buy now and anticipate next year's dividends. And we of course hope that going forward into next year, the pandemic will have come under control and our economy will be on the path of recovery.
My next question, because I was going to ask, we're in a space where Equity Bank has called back its dividend, NCBA has cancelled its dividend, issued a bonus share. Standard Chartered seems to be sitting on the fence, but likely that it will not pay its final dividend. Yet on the flip side, you're saying we are in an economy that could take some time to recover. So the question is, do these banks go back to paying dividends in a year's time? Do we get back in 2 or 3 years' time? Because the issue here is if you're not careful, you can get into a value trap where you use prior period dividend yields to purchase a stock, but then the company may not have the underlying strength to be able to sustain either prior period dividend payouts, basically, or rather largely due to the economic environment it's working on, or rather it's working in. So how do you then mitigate a scenario where you have cheap stocks, but are these stocks really cheap? And do they reflect the future that we're going to be operating in?
I think if you look at the market trends, the stocks are quite cheap. But given the case of the halting in the dividend payment, we may see the prices come down further. And in a time of a pandemic where we do not know the end, we actually, if you hear what the government says, they expect a surge in transmissions in September, August. So who knows, probably in September, August is when it will be worse than we're experiencing right now. So I feel for investors, the best thing would be to have a long-term view, given that these are fundamentally sound companies. They have enough capital buffers. It's just that the current economic environment is proving quite challenging, even for normal business activities. So investors should just take a long-term view of the company. Give it at least 3 to 5 years.
3 to 5 years. Let's now look at I&M Bank. What was happening here? The profit was down 31% compared to a year ago to 1.6 billion. Please walk us through these numbers.
So the decline in the bottom line was due to a 5.7% increase in operating income. And for I&M, we also saw a 24.5% rise in operating expenses. If you look at the top line, the total interest income was rose 5.7%, driven by growth in loans and also 20.8% growth in interest from placement. However, also for I&M, we also saw a 2% decline in interest from government securities, and this brought down the yield to around 10.1%. If you look at the interest expense, it was unfortunately up around 7.1% due to a rise in placement and a decline in interest expense from deposits. Also for I&M, it was quite positive. We also saw the cost of funds come down to around 4.7% from 5% earlier on. So this played out quite unfortunate, because you see the rise in interest income was behind the rise in interest expenses. That is why we see a very, I would say, a slow rise in total operating income of 5.7%. If you look at an unfunded income, it was up a mere 7.4%, which is also quite slow, given that at a time like this, we were very hopeful that banks would be using the unfunded income to grow their top line. And this was the 7.4% growth was due to a 20.9% increase in fees and commissions, and a 7.7% increase in other income. However, there was a 9.1% decline in trading income.
A couple of variables, but it does sound like Standard Chartered, I&M, and the theme that we're seeing all around is really the numbers have been adversely hit because of banks being extremely cautious and increasing their loan loss provisions.
Yeah.
So then, is there a possibility that this loan loss provision numbers could become lower as we get into the rest of the year?
If adopting a really, I would say, aggressive approach, I would say maybe going into Q4, given that for these banks, they have started effecting the restructures, but they're not yet quite there yet. Because going into Q2, we expect Q2 to be quite challenging also for business. That is from March to June. I think once the banks release their half-year results is when we'll have a really clear view of what we expect for the provisions going into Q3. But for Q2 and Q3, I would expect the provisions to go up.
And was I&M expected to pay a dividend for 2019?
Yes, but they have not yet halted their dividend payment. So we stay hopeful that the banks feel that they'll still be able to pay the dividend.
Taken us through I&M Bank, you've taken us through Standard Chartered Bank. I want you to bring this conversation home. So what should we be thinking when we are looking at Kenyan banks in a broad sense? What's really happening, and are there pockets of opportunity?
I would say the opportunity lies in the cheap pricing in the market. However, there also lies some, I would say, risk, given that the banks are mostly invested in government securities. And we have seen that the government right now is not really capable of paying all the domestic debt that they are taking. So we have seen rollovers of bonds once it matures, and we expect that this would be the trend going forward. We've also seen rating agencies downgrade the banks because of their high risk in government securities. So for clients and for investors, I would say for banks, what they need to do is, as I had said earlier, just have a long-term view. It is not really certain that things will change anytime this year. So we may see prices come down even further, which there lies an opportunity there. We may also see maybe if the economy changes next year, of course, we'll see an improvement in the numbers in the market going forward. And we also expect that despite the challenging times, that next year the banks will be able to pay the dividend.
Good points to look out for. I know one can never perfectly time the market, but do you get a sense of market prices correct, 10-20%, or is there a price to book valuation that people should look out for? And the second part to that question would be, are there 2-3 banks that you think offer value in the long term?
I would say for banks, if you look at like KCB, it's trading at close to its book value per share. If you look at equity, so I would expect that for investors, just be on the lookout. I don't expect that the banks will really trade extremely high above their book values. So whenever you're buying, have a look at the book values, have a look at the fundamentals, have a look at what management is saying on how they view the operations. And from there, of course, the dividend payout, which I would not say with certainty that next year there will be a dividend payout, but of course we remain positive.
What's your favorite pick for banks today?
I would say ABSA. They've performed quite well. They're a good dividend play. And despite the restructuring and the separation costs with Barclays, I would say they're still doing quite good. And they also remains an opportunity for growth in the bank. So I'd say my top pick today would be ABSA.
Thank you so much, Linda, for your time. We certainly appreciate, and we'll just take this and say a lot of things are happening, but there's still some opportunities, and ABSA being your top pick, mainly because of its dividend play. And interestingly, it's only the bank it's the only bank that reported earnings growth, at least in the last 1 week. Thank you so much, Linda, for your time. And ladies and gentlemen, we take a short break. Don't go anywhere. We will see you in a few.